Okay, guys, what's going on? Jay here. It's Monday morning. Been going for a couple hours already. Um, I know I'm early today. It's 8:30. Normally I go at 10, but I've just got a lot of stuff going on, so we're doing this live stream right now. Uh, Remember, check out more financial models, templates, and tools in Excel and Google Sheets at smarthelping.com. The template we're doing now will be added to the industry specific bundle once it's finished. Construction business is what we've been working on for the past four streams. This is the fifth. I'll be doing financial statement integration today. Also, remember you can buy all the templates I've ever built for $9.99 on the whole site, and that's lifetime access. And it comes with all these different templates. You can see them bundled here, the SaaS and PaaS models, real estate underwriting tools, industry specific models, a lot of startup bottom up financial models, joint venture distributions, accounting tools and systems, human resource trackers, personal finance tools, more Google Sheet things, sales pipeline, customer management, and valuation. Also, I do custom work for 165 an hour if you want custom financial modeling services. Okay, sound check and check and check. Audio visual good. Let's get this over to Twitter. All right, construction business. So we've got really good assumptions for costs and revenues for the construction business. I'm really happy with how these turned out and the way this works. It's really, really good. I think it's really useful and very flexible. Um, Last time we got down to the EBITDA on monthly detail, which is pretty good. From that, we can build the financial statements, or most of them. We still have to input a capex schedule, debt schedule option, and do an annual detail, and then get all the way down to cash flow, which we haven't done yet. So let's get started. So I will pull the financial statements. I usually go from a template that's already been built, and I want one that's, let's see, what's a good recent one we did? I think the plumbing business, what was this, 10 year or 5? This was 10 year actually. Do I have a recent 5 year one? Manufacturing has a couple different things in it. Oh, that's 10 years. I'm trying to see if I have a recent one that I did for 5 years. Let me try. Wait, let's see. Product. This one. Perfect. 5 year model. And then let me see. Does it have the taxes happening? No. Oh, wait. Yes, this is perfect. Let me just double check one thing. Let me see if this is like 100. No, wait. For just seeing how the tax logic is going here. Okay, let me try one more. Not that one, not that one. Let me see if the product as a service has this. It's a 10 year. See, yeah, that's what I'm looking for. Well, since I have this, I can just use a 5 year model, then paste in this logic, so that's fine. I'll do that later. We just can't forget. Okay, so I'll take, other than that, we can just take a a 5-year template here, and this should be fine. Uh, let's see what's on the balance sheet. Well, we don't have inventory, but that's not a big deal. Okay, this will work. So to integrate these, there's a couple things you got to do. One is we got to add all the tabs names. So let's do that. So we've got income statement, balance sheet, cash flow statement, monthly and annual. That's 6. So 4, 5. There's quite a bit of logic running here in the background in these matrix tabs to make all the dynamic revenues and expenses work. You can see there's quite a bit here. We've got about 1,200 rows of logic going out for 10 years. No, for 5. No, yeah, this. Hold on, hold on. This is a 10-year model. Okay, no, that's good. That's good. That's good. That's perfect. Then I can use the other one. Perfect. Oh, that actually is a huge lifesaver. So I can use the product as a service 10-year forecast. Excellent. Wait. This has depreciation going too much. We can't use this one. We can't use that one, but I believe the plumbing one will now work because that's a 10-year. And let me check the income statement real quick. This is what I want. Yep, perfect. Okay, this will work. All right, so we got to get in all of these different tab names that we don't have. 1, 2, 3, 4, 5. Okay, so there's all the income, financial statements. We also need cap table. We need cap X. We need debt schedule. We need validation. Or not validation. Terminal value. I believe that's everything. And then these all need to have 2 words in it if it's an import, or else it won't work right on the find and replace. So let's do these income statement monthly. Most important is probably going to be the cash flow statement, especially on this construction model. That's where you're going to see how everything actually comes together, and there'll also be a discounted cash flow analysis. Okay, so these we can put a little bit of a light gray. And the names have to be the same as what I'm importing from so that all this can work nice and smoothly. Now I don't have a monthly annual detail yet. Well, let me duplicate this. Better save this before anything happens. So I'm going to duplicate this. I'm not making the annual detail till the end, but we need to have it as a tab name. Also colored this wrong. And 10 years, be right there. Okay, and we can format this real quick while we're at it. Okay, don't need this and don't need quarters. All right, that's fine for now. Income statement, balance sheet, cash flow. We also need cap table, cap X, debt schedule, terminal value. Then over here, we also need to add in high-level executive summary and distributions. Distributions is going to have a 1 on the end because we have to split it into 2 words. Validation 1. Okay, I think that matches. Let me see. Validation 1, distributions 1. Oh, visualization. Oh, that's not actually going to. We can do that after. It's not required for the matching. On the find and replace. This is good. Debt terminal value. Startup costs we got to add and an inventory 1. So here we also want to put in other startup costs. Now these would be like legal fees, website development, things like that that happen before you launch that you have to track. And then what else did I say? Inventory 1. We're not going to use it, but we just need it in here so we have the reference not having an error. We can delete it when we're finished doing the import. Okay, I think we got everything. Now, if you paid attention from January to June, I was doing only what you see here today, these integrations with financial statements. I was doing that for all of the startup models for the first 7 months of the year. It was really hard, but it was worth it. It improved the quality of all the templates. And now I'm also adding it to the new models that I build as I build them, so I don't have to do it, down the road. But it's worth it. I believe we have everything, so let's go. And now what we're going to do is, now this, we've actually already got a global control. That's fine. All that really is going to matter is this part. And then these 2 tax rates have to be in row 30 and 31. This is 6. Yeah, okay. So this is all fine. We don't need to import that. Obviously the revenue, this is all unique to the model. But cap table is the first one we do. So let's copy this logic over. Cap X. Debt. Terminal value. Startup costs. The first couple integrations I did like this, I actually did it manually, and it was hard. And then after a couple, I realized as long as I import with tab names that match what I'm importing from, and the importing names of the tabs that are new have a space, I can just literally copy and paste every tab into the integrating template, and then hit find and replace the workbook reference like you see here, plumbing business XLSX with brackets. I can replace that with a blank, and it will then, all the logic will be linked within this workbook without me having to do any manual changes, which is really, saves hours and hours and hours of time and headache, and reduces errors and all that stuff. It's really nice. So we got income statement. Now it's fine that this has inventory. This construction business is not going to have inventory. We can just clear that row out. It's no big deal. The main thing that this will have is the revenue will be, there'll just have to be a cash reconciliation between what's been earned, which is earned when as a percentage of the job gets completed versus when cash is collected. And you might have cash at the beginning of the period, at the end. Um, if you collect the cash all up front, technically it's unearned revenue, or not unearned, unrealized. And I haven't thought through 100% how we're going to do that. The cash balance will reconcile it, and it'll just it'll start from earnings based on, you know, when the work was done, and it'll zero that out and add in when the cash was collected. I don't know if there's a automatic way that I can look and see, well, is cash being collected before services are provided or not. Otherwise, it's just going to be a simple cash reconciliation, and we won't like put on the balance sheet unrealized revenue, or like a liability account essentially. Let's get the executive summary in. And distributions. Okay, moment of truth. Let's go in here and we want to replace bracket plumbing business.xlsx close bracket across the entire workbook with blank. And there it goes. Nice, 26,000 replacements. That was a success. So you see now, look at when I go to this, there's no reference to that other workbook. It's just referencing the tab name that I put in here. Like for all these, you can see there's no issue. So that's a nice little trick. We'll close this out. We don't need this anymore. All right. Now, what do I want to do? Let's save. Now we need to format everything that just came in, so let's do that. Oh, also on the cap table, to make it easier for somebody to understand, I'm going to just put the default at 100% common shares, 0% preferred A and B. Just so you can see, it's just easier to manipulate if you've never seen it before. So this should always be 0 or negative 100. Okay. By the way, Excel is giving me a little bit of a layover, but not as much as it was. Like when I go to different tabs, Excel was like showing half of another tab is like a glitch. It seems to have stopped um, lately, and all I did was updated the latest Office Insiders version, and that seemed to. You can see the tabs at the bottom are a little bit different looking now, and I think that update also helped with what I had an issue with for the first half of the year. Okay, so this is formatted fine. We can zoom out on this 90%. CapEx is good. We'll do that. Oh, we also need to make these adjustable. Drop down lists. Okay, good. Debt schedule. Make this drop down. So these are just the boring, nuanced parts of building a model, but definitely necessary when somebody goes to use this. These things all need to be working correctly. Okay, C8. Let me make sure C8 is still the yes, no. Perfect. It is. We can freeze this row. Terminal value we'll get. Oh, we'll get to you later. Startup costs. Very inventory we don't need. We can delete this tab. Uh, Income statement. So we want to put all these columns to length, width 15, not length, width, column width. Freeze and or remove grid lines, and this is frozen. Perfect. Okay. Now the annual, we don't need that. Balance sheet, inventory we don't have. We can clear this. Okay. For financial modeling, if you have to reuse logic, it's really good to have a base template to work from, because the least amount of manual work that you need to do or redo over and over that's monotonous, and you can have it perfectly done already and use a template, makes it very good. Less errors, quicker, less manual touch. It's just a good place to be. Okay, this came through good. I realized on the annuals, if I copy the columns like this when I paste it, like copy here, rather than on the monthlies, when I pasted over, I just clicked it and went like this. If you do the columns, you get the column width already formatted, so that's good to know for the future. All right, here, inventory we don't need. All right, this looks good. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . Okay. And I'll have to update. Obviously, there's going to be updates because the position on the monthly detail of data is different than um, the plumbing business. So all this has to be updated, but this should work. I'm trying to see why. Where's this 5 cent error coming from? Is this the same gradual amount? 40. No, that's going up to. Well, we'll get into that later. Executive summary. We got a format. This we want to zoom out a little bit. Same here. Okay. So first things first, let's just do the annual detail while we're in here. So started jobs, obviously everything that says month is year. Okay. Um, so started jobs per year, we simply do a sum ifs on our monthly. If the year matches. Okay, we want to lock this and row 2, so we can drag this down and over as much as we want. Now, ongoing jobs at year end is going to need to be an index formula because it's not a cumulative. So we index ongoing jobs at month end. If this year matches E2. And, oh wait, no, we don't want to match we want to match the date in in row 4 of the monthly. If the dang it, no, that's wrong. Hold on. We want to get row 9 if 4 matches, and we don't want the year, we want the end month. So E date E4, comma 11. Now what's wrong? Give me 9 if this has to go ahead. I forgot. And there's your array, and then we can delete this. Okay, so ongoing jobs, and this will just be a function of your assumptions. So it's saying at the end of each year you've got 24 jobs ongoing, and that's just, you can see once you get to 24, you you finish a job, but you add a job essentially. So we're stabilized there. Now that would change if you changed your revenue assumptions on how many jobs were started per month. Okay, and then sum ifs we can do for this, and then we should be good to go to drag everything down. Now if the length, okay, so the length it takes to complete jobs we have happening, let's see, takes 7 months. So because of that, you're going to see offsets here. So the earned revenue and the cash collected will be the same in the long run once you're stabilized. Now, if you keep growing and keep, the jobs you're starting per month is growing over time, then these will not be the same. They'll continually be growing, so the numbers are different between when cash is collected and the revenue is earned, unless you collect cash as the job is completed, which could be, and in that case, they'll be identical. So in these percentages here would be the same as this, and you could easily select that. And the reason why I did these percentages is you could have different terms like 50 up front, 50% at the end, or 100% at the end, 100% up front, or percentage while completed, or some other, or even percentage over the expected life. It didn't make sense to code all those individually. Instead, I just did percentages. So over the course of a timeline of months, you can put the percentage of the job that's completed on each month for job type 1, 2, and 3. These all have the same assumptions, configuration inputs. And then when cash is collected over the job or life cycle of a job, you can put that in here. In this case, it's saying you collect 10, 10, 10, and then 70 at the end. Now, this could be different for every single use case, and it might be, depends on how long on average your jobs last for each job type and all different stuff. Now, materials and equipment costs, those costs are derived from here for each job type, and then when you pay is what's going to hit the financials whenever you have these percentages hitting right here. So the configuration was designed to be as flexible as possible without having to manually hard code in logic for when how you cash is collected and revenue is earned. Note, for hourly wage workers, the salaries, benefits, tax, payroll taxes, all that will be driven off the function of when percentage of the job that gets completed, because this calculates the total amount for the whole job, and then based on how long jobs last, that percentage will fill in there. Okay, anyway, so and these two won't match because, and I guess they potentially could if they were identical, but assuming there's offset between revenue earned and cash collected, these will normally not be the same unless you stopped your jobs at some point and then you kept the forecast running just to see. Like you could stop these jobs started per month are manual input. You could stop them at some point, zero it out, and then the cash collected versus earned would eventually equal each other. Now that we have this, I should be able to just copy and paste this down. And then total cash collected is 2739. That should match this. It does. And then this is 2773. Perfect. Alrighty. And then the rest of these could just be sum ifs, all of these costs here. And I can copy these down. Okay, and gross profit 1255. Perfect. Now our fixed costs for operations. Same deal. Okay, and that's good enough for right now. We got down to EBITDA here. This should match 193. Yep. Okay, let's go to the income statement, but we want to see, we're going to pull in earned revenue. I'm trying to think if we want to break it. Well, actually, there's nothing to break down. It's just job type 1, 2, and 3, but we're not going to do that. So this is just construction revenues. And we'll simply reference this here, total earned. Okay, cost of goods sold. So this, for construction business, I looked up a couple income statements, and the general terms used were construction costs. And for that, we have 4 types: materials, equipment, wages, payroll, and those are relevant to break down into separate items. So we're going to do that here. So we got 4, plus we're going to have startup costs. So 1, 2, 3, 4. And startup costs, not as in if you're buying equipment, like CapEx you can put here, but startup costs is in other non-depreciable items that you got to pay for before the forecast starts that you want to track. Also, you can put a reserve in there. Okay, so we have this, and then this is startup costs. What's an E55 that's causing this? Percentages. Okay, that makes sense. I was wondering what was causing this here. Okay, so that's cleared off. We don't care about that. We will format this for accounting. Okay, same with these. Oh, we got a 1, 2, 3, 4. Dang it. All right, so let's get these costs of materials. We have, did I separate it out? No. So we can just go equals this plus that for each job. Equipment costs, rentals here. And you may not have rentals if you're buying all your equipment, and that's fine. You could configure that on the assumptions. Wages and payroll taxes. So we're considering all these construction costs. Now you could have other payroll taxes for, executives and other employees, and that's fine. The way you would account for that is simply, I'll show you 1 second here. On these other OPEX items, you'd put their fully loaded salaries here, including payroll tax and benefits, like the monthly cost in year 1 and year 2, etc. Now I have to take a bathroom break real quick. I'll be right back. Should only take 5 minutes. And we'll continue on. Okay, I'm back. Sorry about that. Okay, the sound of the phone's working. Um, where were we? Income statement, I believe. Clear this. Um, okay, yeah, here we go. So income statement there. We also have our fixed cost of sales and marketing. We have here G&A. And other OpEx we're putting as this and this. Okay, now I'm going to do a special format here. Once I finish doing the statements, because I want zeros to be dashes essentially. This looks good. Okay, let me just make sure we have drop downs for everything real quick. Um, so you can see this is already built in. The CapEx logic is working fine. And if you were to buy your equipment instead of renting it, you can put those purchases here. You'd probably have to do tranches, and then they'll give you some depreciation based on useful life. And what there's like 15 slots, so you can group your equipment as long as the useful life is the same and the purchase month is the same. You can group, as many as you need to account for a lot of different equipment pieces. But that's the logic already all exists here, and that's completely good. Now the income statement, we need to copy this over. We're gonna go copy, not all of it, just this part. Oh, got extra space in here. And now what's nice is, so when I did that find and replace, all of this logic is already set. So I don't have to do any of the three statement modeling logic because it already exists. And all of it should already balance. It's just a matter of referencing the right places on the income statement. So if we go over here, looks like this is just the startup cost amount that we're off by. Let's see. Now remember, we're going to do some cash reconciliations for revenue earned versus cash collected. Let me just see here. Is this? Oh, shoot. This is needs to be adding all that up. Whenever you're extending subtotals, you always want to double check those and make sure you're targeting everything. We've also got to check here. Well, so the sum of this should equal the sum of the monthly as a sanity check. Perfect. Okay, now the formatting on this, I want to do not the percentages, but everything else, just so it looks more professional. We're going to format these as custom. And I like this one here. I believe does have a dollar sign. this one because we need the 2 zeros. So it looks a little bit better, a little bit cleaner. Format, actually this will be easier just to do the whole thing and then just unformat the percentages. Okay, so the income statement should be good. Let's look at the balance sheet. Oh, we got big differences here. Let's figure out why. Well, number one, let's look at the cash flow. So we have customer receipts in here from C9 income statement. That's total revenues, so that's good. We have to reduce earned revenue, and then we're going to have to add when cash add cash received. So we actually just this is going to be the negative of this, and then we actually got the cash when this number here, so we balance. So these two have to happen. OpEx, so this is taking 28 and 16. That should be fine. That's these totals. Oh, no. And then we need 18. Yeah, we need 28, which is all the OpEx, but we also need 18, which is the specific construction costs. So we go here, we want 28 and 18. That's probably why we saw a variance on the balance sheet. Okay, so there's that. Interest. That looks like it's going just fine. And taxes, okay. That's summing up all of that. Now on the annual, we got to do the same thing. So let's add a space. Put this in here. Drag this down. Okay. Let's also format this, indent these a little bit. And if you wanted to indent more, you can always, so you could go accounting. You can also do, where's that? I just did this the other day. Oh, that might have been on Google Sheets. Oh no, here it is. Increase indent. So you could make this, over as far as you wanted. All right, looking good. Let's give these an indent. I wish you could go across multiple workbooks with the holding the control down, but you cannot, sadly. All right, does this balance? Nope, we are still out a whole bunch. Let's figure out what's going on now. We'll first does the cash flow statements match? 1.187. What is this? Yes, these do match. That's good. Also, we're going to format these with this custom, just so the zeros are dashes instead of zeros. Looks so much cleaner like that. Same with the balance sheet. Now, we got a pretty big variance here, but it's actually going to be easier to figure out what the problem is with such a large variance. Um, and actually, before we get into that, we do need to adjust or make sure our terminal value calculation is working right. Okay, so we got our formatting. Let's see. So 350. It looks like it's calculating. Let's see. So trailing 12 months EBITDA. Do we want to use that as a valuation technique on exit? I believe. What is this construction business? Yeah, it's just a rule of thumb. It could be based on all kinds of things, but trailing 12-month EBITDA is a fine way. You could also do it as a percentage of revenue. So let's make sure that's doing it right. So income statement 31. Yep, that's EBITDA, and then our multiple is here, 3x. So that is our terminal value. We are overflowing some of that to CapEx for capital gains taxes based on anything that's got a useful life remaining. Okay, now the question is, why is this really too big? I guess, yeah, 1.1 billion. Let's extend these out a little bit more then. So I guess 16 should be enough. That's one thing I know people hate is opening these up, especially if they're not used to Excel and they see that like little dashes or hashtags in a cell and they're really scared of what that might be. And they just need to make the column bigger. But by default, this is big enough to hold billions places, so that should be good for most people using this. Now every model is different. The main difference that you will see in the templates I build are with the revenue and expense assumptions. There's no other logic I had that was even close for a construction business, so that's why I had to build it from scratch. And then now the income statement, balance sheet, cash flow statement are similar statements you see in a lot of models. And those are driven off of the result of the bottom-up assumptions we've already built in the last 4 streams for this build. So the key is getting it into this monthly detail. This monthly detail is probably the most important tab we have by far. This has everything you need to build your financial statements, well, most of them. Now we've also got cash flow items like debt service, taxes, interest. Well, I already said that, debt service, um, exit proceeds. All of that is going to have to be added here before we get to complete the model. We will use this monthly detail to get down to the minimum equity required, so that is going to be useful. We also have to do the executive summary, distributions, so we're getting there though. Where was I? Cash flow. Oh, right, terminal value. Are we still out here? Yes, we are quite a bit. Um, 6.9 million is a big variance. Quite a big variance. Let's look here. So we're zeroing this out. We're adding the cash received. Sale of company stock. This is going to have to be Okay, I guess we're not going to balance till we get this. So let's start adding in our other cash flow items. So we have principal, interest, total debt service. Um, we also have exit proceeds and capex. And then we'll have cash flow, cumulative cash flow. I believe, and then that should get us to balance once we add that in for equity coming in. Oh, and startup costs. Put that in here, as well as debt proceeds. Put debt proceeds up here with this. Okay. All right, so principal payments we have, I believe, here. Interest we have here. Total debt service. Now, trust me, a lot of work went into making sure there's no circular references that will happen. There will not be. Debt proceeds is a little trickier. We have to say if this month equals our debt takeout month, then give me the total. Okay, exit proceeds we have already on the cash flow statement, and it's these two. CapEx, we've already got built in, and startup costs will go here. Now, these need to be a negative. Oh, this is a negative, I believe. Yep. This is a positive, positive. These are negatives, and this, okay. Let's format all of this. With our nice dashes. We don't need zeros, so perfect. Okay, and we'll just put up here values in USD. And we'll put that actually like right here. Okay, and then let's do the same thing for the annual. Really like those dashes for zero. Oh, shoot. Whoops. See, it just looks nice with the dashes where it's zero instead of showing a big zero. Okay. Annual detail still needs to be fully updated, but I can't do that until this is updated. All right, so cash flow, we should be able to sum up from EBITDA right down through to here. And then cumulative cash flow is going to be how we figure out how much equity we need. Drag this on over. Okay, looks good. Lots of sanity checks to do here. Let's copy and paste this to the annual. Now let's see, so this These all sum formulas. Now this is tricky too. This has to be equal to that, otherwise we can sum ifs the rest. Proceeds, exit. Now we'll know if we got everything because, well, first of all, this should equal this ending balance. Perfect. And then our balance sheet should solve for zero cash because we're figuring out the minimum equity required. All right, I just want to make sure these work. Let me do a couple quick checks on the debt. Like if I put it to May, okay, that did not, oh wait, let's go over. Okay, so that did come through there. Okay, good, 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 good. And then let's say we don't include the exit. And let's say we end at some point here, just to make sure all this works still. Okay, that looks good. No exit coming through, and debt is just going forward. All right, perfect. So that's working fine. Put this back to yes. Terminal value, we can reference this directly. What else do we got? So let's look at the balance sheet. We're still out quite a bit here. Let me go to the cap table. Okay, so this is, so this is where we figure out we want the min of our monthly cash flow right here that takes everything into account. Oh, but hold on. We also, to reconcile this, have to, where do I want to put this? We can go to above. We want to reduce earned income, add cash received. Remember, we got to do that. So we negative this, but add this. To get the actual cash flow. And we're going to do that on the annual as well. And I believe that's the same as doing a sum ifs because all we care about, yeah, these two, that's fine. Make sure that's summed up. Okay, so that's matched. Now, the minimum cash here, so it's saying based on how we collect cash, we actually have enough money to cover our initial burn, which is good. If we didn't, let's say on here, let's say we have to pay for 100% of these costs up front for materials and equipment, and let's say we collect cash 10, 10, 10, and then let's just say it takes 7 months to complete, so we're going to just say this equals essentially an even amount here. Just playing with these numbers real quick. So we complete 100% of the job. We get paid evenly over the job by month. Average value, let's make this average job 1.5 million. And our cost, 8, 9, 10, 11, 12. Not a huge margin. Let's go now and see what this looks like. Reduce this, and we're still receiving a ton of cash. Oh, because I only adjusted these for job type 1. Let's go job type 2 as well, make them the same. Just for the purpose of seeing what happens when there's a bit of a burn. Okay, 100, 100. And these are your checks to make sure each of these rows adds up to 100%. All right, yeah, now I expect to see some burn. Now the question is, do we get profitable? It appears not. So based on the assumptions I just did, we actually don't have enough revenue. And this is why this model is good to use. You want to make sure what you're charging for the job versus what it's costing per job, including labor, it needs to work out, right? So we aren't charging enough for these jobs, so we have to go higher. So let's say 2.5 million. No, not 25 million. And this is how you figure out pricing and scale at a high level. Okay, there we go. So we got some burn happening here, and then we kind of stabilize. Now we're going positive. Okay, great. So then the minimum cash we need, 8 million. Investment funding, we'll pull that right from the cap table, which we have here. Now we put in numbers. Why is this -8? Oh, whoops, this has to be a negative up here. So this is saying we need 8 million to get this thing off the ground, to cover burn, startup costs, etc. Investment funding, percentage, fully diluted share percentage, and then owner equity is this amount. Okay. So this looks better. Let's go to our balance sheet. We're still out a little bit here. And we're not solving for 0 here, so there's definitely some issues. $8.5 million variance. Let me make sure these are the same. They are. All right, so where is our issue? Let's see, the first month it says we're out 571. 571,000. So to figure this out, let's first look at the cash flow on the monthly detail, because this is what's driving. So this would be this plus this. Against equity coming in. All right, and that's probably is that our variance? No, 688. But there is a variance there, so that's an issue. So something's referenced wrong or something's going wrong here. Let's see. 2 million cash received. Let's put this back to the first month. Now here, I'm out 6 million. This is 500,000. Am I missing something on the monthly details? The question. Well, we are double counting. So hold on. this should be EBITDA plus that plus this. Not a huge difference though. That's not enough to figure out why we were off. Also adjust this on the annual. I mean, how is this out 6 million? We got 8 million in here. Monthly detail for month 1 is 1.9. And then our variance is that. So something's missing from something. Let's go back to the income statement. Let's make sure we're not double counting this. So my gross profit, 1.4. 590. 590, 110. So these are right, 419. Okay, so that's good. OpEx, 183, 109, 166. Yep, that's the same. 212, 259. Oh, wait. Yeah, 212, 259. Okay, so that's the same. So EBITDA 1.36. Yeah, there's a difference there. There is a difference. That's not just a startup cost. So let's see. Total OpEx 183. So we know these are right. Let's look at month 2, 700, 455. Wait, those are right too. What are we missing in month 1 that's so different? I guarantee it's something dumb. It is something dumb, but we gotta figure it out. Yeah, 261, and if you adjust the startup costs, 130. Wait, are we double counting startup costs somewhere? Not here. Let me make sure this is doing all of these. Okay, so that's other OpEx. What's this doing? Construction costs. Yep, that's the same. 2,000,450. What is going on here? Oh, wait, taxes. Okay, taxes. That'd be it, or at least one of the things. There's always something. All right, and now we reference that right from the cash flow statement. I believe that 588 is what we're out by. These got to be summed up. Okay. Okay, we're still out, but 571. 571, 428. That seems familiar. What is 571? That seems so familiar. These are the puzzles. This is why doing three-statement modeling, um, it can be very hard, but it's good because you know you're correct when you're balanced. We're out. We're out here. What's the difference between these two as well? 0.5. It's kind of erratic. What in the world? We're out. Let me look at the annual. The fact that this is an even number, 8.5. What is 8.5? All right, let's go back to the cash flow and see. So now we're at 8 million here. Let's look at our monthly detail and see if I mean, we could be missing something else. Or a sign could be changed the wrong way. Let's go. So month one should be this plus equity and startup costs. All right, good. So we're out by startup costs. So that matches. Let's go to month two. Cash flow. Okay, so we're actually balanced here, which is good. This matches. Our net change in cash matches our monthly detailed cash flow. Now the question is, why something between our income statement and our cash flow is not matching on the balance sheet? Now this has got 8.2, which is that. I mean, what? This is a big difference too that's causing this. Like, we're starting to get some big variances here. What's weird is you've got an even 6 million and then even 8.5. What? What is even going to cause that much? 8.5. It sounds like something with revenue. So one way to figure this out, let's change this. Whoop. Okay, and let's see if that messes. Yes. Okay, so that did. Okay, so our issue's got to be something with revenue because this now changed. So it has to be something with the reconciliation. So let's make sure on this we're taking 24775. So 24775, then we're reducing that out, but we're adding cash received. Monthly detail E26. Cash collected. Right, so this basically doesn't happen, and then we have this much cash actually coming in. Same here. Now, why does the balance sheet not like that? Says this retained earnings. The only real impact here would be between cash and retained earnings. Uh, do we need to put in a difference? For example, is there a liability we got to track showing the difference between these two? And it's weird because you might collect cash all up front or at the end, so you don't know if it's a liability or technically like a receivable, or we just need to know the difference between these two. Is this what 678? What are we out by? Ah, that is it. Okay, so we have a difference that we need to track, and the balance is potentially a liability or an asset. I'm just going to put it right up here, and I'm going to call this uh, rec. Let's see. We're going to call this receivables slash unrecognized revenue. And honestly, it's just showing you the difference between, and the balance will be simply what we actually earned but against what we, let's see, does that do it? No, that was the wrong way. So that needs to be a positive 678. So it's what we earned in revenue less what we've actually received in cash. And we simply figure out that amount each month and add the previous amount. So there, and now we balance. So this is like just an accrued amount, and you can see there, this is when we actually have collected everything that we've earned. That's why you saw that zero there before, and then as we go on, so that's just an account to track the difference between the two over time. Over the long haul, it's just the same number. So here in this case, if it's positive, it means we haven't collected as much cash as we've provided in services. So receivable. Yep. Okay. Good. Because I want it. So if it's an asset, it needs a positive balance as an asset. So this is like a receivable. If it went negative, and I'll show you how to make it negative if you adjusted the assumptions, it would mean we've collected more cash than we've earned. And that you could do if you put like all this at 100% up front. Let's say you collected the cash up front, right? On all these. Instead of over time. So if you collect the cash up front, now look what happens. It's negative because that now is revenue um, it's now cash you've collected, but you haven't provided the services or finished the construction yet. So this is technically a liability. Now if we go over here, it's saying 51.5. So that essentially means over the long term, you have 51.5 in revenue that you have not provided services for yet, but you have received the cash for. So that's why the cash is going up here, and the cash is, I mean, now we only need barely any money from investors. It's actually not even a negative number. We only need the amount for startup costs. And this is actually negative because there's too much. But that's not likely. Usually there's no situation where you're collecting 100% up front. Maybe 50 and then 50 at the end. not for that one. So this is kind of common. We'll probably put this as the default, 50 up front, 50 at the end, or it could be as the percentage of the job is completed here. And again, it could be after job is completed, and then you'll have that receivable account still, and so now it'll be positive. Well, actually, it's negative a little bit because collecting that 50% is more than what you've earned, but then over the long run, eventually you get into a point where you have a receivable balance roughly of 8.5 million. Okay, so that's fine. I was wondering, in this check, this needs to be just a number. Okay. Okay, that's good. So we're balanced. Oh, wait. So we actually have this row on the balance sheet still, but it's not called the right thing in the annual. There we go. All right, good. That's awesome. So there we go. We're all balanced. Executive summary. Let's try and do this real quick. We can put job type 1 revenue, job type 2 revenue, job type 3 revenue. Here, let's pull that. So revenue, we're doing earned, 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 earned. Let's give this the fun formatting as well. Which is it? This one? Yeah, that's fine. Values in USD. Okay, now this is actually going to be construction costs. Here, and then G&A. We'll have this and this. Sales and marketing. Now we got to add another one here. These are percentages as well. We have R&D potentially. Now, actually, that's probably not going to be used. We're going to just throw that into G&A. And we'll call that general administrative and other. Question is, do we get everything? So this EBITDA is 717,097. Yep, we did there. Okay, what else do we have? So add back. So for cash flow, add back earned revenue, reduce add cash received, reduced earned revenue. So we just take the negative of that, and then cash flow in is here. Okay, CapEx. I don't know if these are the right positions because we just have to do it manually. Debt service. Let's Startup costs, that's correct. Proceeds from exit. That looks correct. Loan payback we don't need. That'll be in debt service, taxes. Now I should be able to simply sum all of this plus EBITDA. Okay. Running cash flow, cash position. And our check is this minus this. Looking good. All right, cool. Just eye testing these. Okay. Distribution. So this is going to be based on the monthly cash flow in 183. Oh, it's almost the same. 183, 83. I'm really excited to get this construction model out. It's going to be a good one. I feel like it's super popular. Like it's got a lot of uses. It's very flexible. And really, what I'm really excited about is this balance sheet. This item here showing receivables or unrecognized revenue. This is awesome to see, and it's completely dynamic based on these percentages entered for each job type for cash collected versus when it's actually earned. I believe that makes it really usable. And the goal here, the main goal is going to be to figure out um, cash flow and cash flow requirements. That's what we're trying to do. And that's what this is focused on, built to do. Okay, let's give these the cool formatting. Percentage. These are percentages. All right. Check this against annual detail. Now this is out by 30,000. Let's see, what do we probably didn't. So remaining equity to use is going to be cash flow in period 0 plus equity, total equity here. There we go. Now we go to 0. Let's check. That's fine. D3, yep, that's the total. And investor cash flows through, yep. J31, good. That's right. Okay. Looking good. So this is done. Executive summary is done. Let me make sure this is distribution to B12, B10. L, yep, perfect. L. Now these should match if I add them together. Perfect. All right. Everything's done. Now all I have to do, which I'll do tomorrow, we'll do visualizations and sanity checks, which is all this these down here have to all match up. Other than that, we are good to go. I'm happy with this model. It's awesome. Now, if you want to check out more financial models, templates, and tools, you can go over to smarthelping.com. The industry-specific bundle is where we'll put this construction business model when it is finished. It'll be a $75 one-time fee. Remember, you can buy all the templates for $4.99 on this bundle, and it includes lifetime access. So if anything's added, you just ask for a refresh, and I'll send you over the latest zip. If you want to buy all the models on the entire site, you can go to Financial Models tab at the top. $999, that'll get you everything I've ever built. There's all sorts of stuff in here. This is the industry-specific bundle here, but you can see there's other templates across my site. Everything's very valuable and useful. Um, this is just all the really useful logic and things I've built, um, business logic I've built over the years. Alrighty, I'll see you guys tomorrow morning, and we'll finish up this construction business model and get it posted live. And I'm looking for suggestions on the next business or industry specific model to go on.